Right, so our third speaker tonight was Areiel Wolanow. Areiel runs a really interesting project at Lloyd's of London, the insurance market, and they're deploying a blockchain solution to solve their back office problems around settlement and claims. So without further ado, please give a big, massive welcome to Areiel. Over to you, sir.
Thank you. Thank you very much. Good to meet you all. My name is Areiel. I run a small consultancy called FinServ Experts, and I am currently leading, or have led, the delivery and deployment of a set of DLT prototypes for Lloyd's and the London insurance market. So it's an enterprise blockchain solution. It's not crypto, it's not tokens, it's not ICO. The solution got delivered, it runs, it works, and I could demo it, but I'm not going to because you actually don't care about my product. You guys are here because you're passionate and you want to do this. So what I thought would be more interesting than telling you all about the features of a settlement and clearing system for the London insurance market, I would talk about the journey of how we got a major and very conservative organization like Lloyd's to approve doing this project and to get to the point where we are now. So as I said, we've built the prototype got delivered, it got accepted. My team is now writing the RFP for a full production solution, and the issuance of that RFP has been approved. So this, what you're seeing here is the real deal. A little bit about the London insurance market. They write and manage over 91 billion of policies a year. They employ 52,000 people. They account for 26% of the GDP of the City of London, and they are losing market share. Now, some of that is structural because Lloyd's is the very first financial market of any kind in the world. So when you start out being first to do something, by definition, you have 100% market share. And so it's always going to go down. But that was in 1688. And what's happened since then is that the rate of market share loss is accelerating because many of the business processes were developed in the first 50 years of Lloyd's existence and were more or less codified by the 1730s, 1740s, and are still being used. Largely paper-driven. What computers there are green screen mainframes, and there's a processing bureau of over 1,000 people settling these trades and claims. So why on earth would this organization ask me to do this, ask me to lead this project? I'm not an insurance guy by trade. I was with IBM for 12 years. I built the blockchain services practice for the ASEAN region. In that role, I sold and then delivered IBM's very first blockchain consulting project, which was a trade finance prototype for HSBC and Bank of America. I saw earlier this year a LinkedIn post I absolutely loved that said, and it was by one of Vitalik's friends, and he said, "I am tired of hearing about blockchain experts. There aren't any. We are all of us just figuring this out as we go." So I've been doing this since 2014. The first deal that I solutioned was supply chain provenance for fair trade coffee in Ethiopia. The client was the Ethiopian Commodity Exchange, and they had a huge problem with corruption. Basically, every farmer in Ethiopia was putting their coffee into fair trade bags. So at that point, the only blockchain solution that IBM had was a pilot that was running in their cafeteria at their R&D lab in Atlanta. So it was very early days. Left IBM, started my own company, and ended up here doing this. So the London market is not run by a bunch of idiots. They're aware that they're losing market share, and they undertook a huge program, 50 billion plus program, called the London Market Target Operating Model, and it had a lot of goals. Just keep rolling through these, getting better diversity, better business environment, but mostly making the London market an easier place to do business. And this is really where the gap is growing, because right now, especially with the emergence of Lemonade and other solutions like this, the amount of time it takes to process a claim in the insurance industry around the world is getting getting shorter and shorter, and Lemonade famously paid a claim within seconds of the claim being made. And we're also looking at parametric insurance, where there is no claim. The event happens and people get paid before they even bother to file a claim. So the average time it takes to pay a claim that's for a policy issued through Lloyd's is in excess of 400 days. And during that time, it's being handled by this bureau and it's a black box. So if you call your broker and say, "Where's my claim?" they can't tell you. So that's where they are now. So the LM-TOM program, which is much bigger than, it's a question? Oh. What? No, I don't. I have 20 minutes to talk.
Yeah, you got loads of time for Q&A at the end, don't worry.
Okay. No, so Olga and I agreed. So you got to listen to me for 20 minutes. I apologize. But it gets better because you get to talk to Steve afterwards. So the LM-TOM program, massive program, they issued a bunch of projects that prima facie have good business cases, things to make it easier. But somebody said, unless you deal with this core problem, this bureau, all of these great projects are just rearranging the deck chairs on the Titanic. So they commissioned a feasibility study that asked two questions. Could a more effective and significantly lower cost operating model be created that had no central processing capability? That was the big question. And if you could conceive of such a model, what would be the economic case for doing it? Now, these are key questions, and none of them actually say anything about blockchain, okay? And that's important, because we built the business case in 2017. That's how we got permission to write the prototype. The business case, which was accepted and believable by the market, showed a net benefit of over 110 million pounds per year of cost reduction from getting away from this manual solution. So I've been doing business transformation for 30 years. I've never seen a business case this compelling. When I first ran the numbers, I didn't believe it. I had to ask a bunch of people to debug my model because I could not believe the order of magnitude of the cost. And then I actually brought someone in who was a fierce opponent of blockchain. And I said, please look at these numbers, and something wrong. And he ended up telling me. So we got the business case approved. But the business case isn't about blockchain. The business case is about a decentralized business model. So I'll walk you through some of the thinking that we did. This is just, you don't have to memorize this. There's no test later. This is all the things that this process, that this bureau currently does. So not a small thing. So when we say, is it possible to conceive of a decentralized business model, that's not a trivial question. We had to have a team of analysts go through, look at each of these and say, okay, it's very easy for us who are true believers and woke to say, yes, this can solve it. But we had to go through and actually prove it for each of these process areas. So thinking about business models, one more, okay, stop there. The traditional business model for a financial exchange or for trade finance or for many of the world's business networks is a service provider where you hire somebody to do that. And one more, that's great, but the service provider has a problem, which is that they are motivated by profit. So the only benefit that you get out of it is what you are clever enough to contract for. And even if you've got commercial geniuses who negotiate a great contract, that's at a fixed point in time. What you'll find over time, and this is not slamming BPO, because I know many very high integrity people I respect working in it, but through just human dynamics, what you get is an ever decreasing level of service for an ever increasing level of cost. So you could sort of prove that through human dynamics. That's not a slam on anybody. It's not saying that they're evil. That just happens. So you say, okay, so the next step is let's found our own BPO. So let's create a new organization that we, the users of this service, own. Now this is a hugely successful model. Okay, MasterCard is a co-op, Swift is a co-op, Lloyd's itself is a co-op. Okay, it's owned by the members. So with a co-op, you at least get to the point where the strategic interests are, heart in the right place. It's not extractive. Their job is not to take profit out. But what happens in the case of a co-op, though, is that they, stop a second. What happens in the case of a co-op, though, is that they see themselves as the center of the universe and the solution to every problem. And over time, the power relationship inverts, okay? MasterCard is founded and owned by banks. But ask any banker if they have any luck at all telling MasterCard to do something. Now MasterCard tells them what to do. And this is not what the members of the London insurance market want. They're tired of being told what to do by the current bureau. So now we think, okay, let's do a distributed model. A model, stop there, where there is no center. Okay? There is no organizational mass to gather inertia and gather power. Okay? You remove the center from it entirely. So if this is so much better, go back down, go one more slide, please. We actually did a whole analysis, and again, I'm not going to go through this in detail, that talked about some of the things that, that matters, the objective, the degree of control, transparency, implementation risk. So we did this whole analysis. And you ask the question, if this is so great, if a truly distributed business model is so much better in almost every dimension, why haven't people done it before? Well, it's a great question. That's where blockchain comes into it. Nobody's done it before because it's very hard to implement. Okay, when we looked for a reference case, so we could explain to people what a truly distributed business model was, we could only come up with one example, which was GitHub. GitHub, it looks like you're logging into a GitHub site, and there must be a central server. Those of you who've hosted open source projects know that's not the case. So GitHub is a truly distributed business model, but I'm sorry, you cannot use GitHub to explain as a reference case to a bunch of insurers. It's not going to work. So at this point, we say, okay, so we've got a model we believe in. We've proven even to our fiercest opponents the business case. So what do you do normally in business transformation when you prove a business case? You go on to gather requirements. So if you do that via a traditional methodology, you would hold a bunch of workshops, you'd bring in some experts who know what they're doing, and you write a requirements spec, you get that spec signed off. Say you're a little bit more forward thinking, let's say you're going to do it in Scrum, you get some product owners to embed in your team. They are empowered by the business owners to make decisions, and you come up with a product backlog. The problem with all of these methods, whether they're traditional or agile, is that they won't work if people don't understand what a distributed business model is. So what we decided we had to do was to build this prototype, to say there's no way we can even begin to articulate the requirements for a production solution unless we can put something into people's hands and say, this is what it means to process claims in the new world. This is how a customer will interact with the market. This is why it will, we will save over 110 million. This is why the customers will have a transparent view of where the claim is at any point in the process. This is why we think we can net settle in real time rather than the minimum 3 days, and this is why we think we can get the average time to resolve a claim from over 400 days to below 90. And because it was there and it was physical and it was something in their hands, they believed it. And that, to my mind, is the reason we did the prototype. Because that was the goal, we also did something else, which we said the prototype was developed as iPad apps. There was an app for the insured, one for the broker, one for the carrier. And the reason we did that, there was some research done about a year and a half ago. No, actually, no, it's 2.5 years now, in Princeton. They built 2 prototypes, and this wasn't blockchain. This was some other technology, I forget what. But then they asked for people to take part in reacting to the prototype. Half of the group they emailed a link to. The other half they put an iPad in somebody's hand, and then they measured the level of emotional engagement. If you put something in physical in their hands, it changes the way they interact with it. there's nothing magic, there's no reason to prove that this works, that you needed to do it. But we hired a very expensive UX designer, we created apps, we put it in people's hands, and it shouldn't actually impact their judgment, but it does, and we took advantage of that. Next slide. So the biggest challenge, though, has nothing to do with technology. In fact, you could implement a distributed business model without blockchain. You could use peer-to-peer messaging. You'd be daft, and there's a million reasons that would be less efficient, more expensive, less secure.
Can we just touch on one of those? Let's pick the top one. Broadly, subject matter, I get it, but what's the number one reason why you wouldn't use a normal database type solution?
I wouldn't want to, I'll pick three. I can't pick one.
Okay, let's go for it.
In terms of testing, you've got the n² minus 1 problem. You've got 400 market members, and you want to test the messaging between them, each running their own messaging node. That gets very expensive very quickly. It's also less secure.
Yeah, I'll buy that one. Okay, second.
The second one is around data ownership. Theoretically, today in this bureau, each market member, and so there's 400, owns their own data. Good luck trying to get it. But if it's sitting in your node, in your data center / slice of cloud, what we'll call you have access to. You can go grab it at any point in time. And yes, we did have technical solutions for the fact that blockchain is not exactly the most queryable thing. But we invited 5 vendors to do this, gave them the same spec, and said, here's a quality bar we're going to evaluate. If and we weren't picking one. We said, if you meet the bar, you're going to get the RFP for the production solution. In the event, 4 out of the 5 succeeded, and that alone is a proof point. We said we gave 5 qualified firms this spec. They built us a working DLT, claims management, and a transaction accounting system in 14 weeks. That's a powerful assertion by itself. 4 out of 5 were able to do that. Gave them the choice of using Hyperledger or Corda because those are the 2 that have enterprise support models, something Lloyd's would care about, and that didn't impact both. The successful people used both.
What was the third one? That's 2. What's the third one?
No, we gave them the choice of Hyperledger or Corda.
Oh, that's the third one, right? Okay. So
Yeah,
they got to choose the protocol.
During so we gave them the choice of 2. During the feasibility study, we looked at 8 and we chose those 2. And the reason we gave the vendors those 2 to choose from was, at the end of the day, they had enterprise support models, and Lloyd's just wouldn't be interested in something that didn't. Ethereum Alliance, I'm sorry, it's the smoke and mirrors. It's not there. We did look at some of the newer and more scalable. We looked at Hashgraph. We looked at Stellar, but they just didn't have a level of industry support, again, that a very conservative organization like Lloyd's would be interested in. Like I said, I don't believe it. Ethereum has a governance model that is dominated by ideologues. I happen to agree with their ideology, but it doesn't make it suitable for enterprise applications.
Resist the temptation to ask questions, please. You'll have your chance.
But the biggest challenge is not any of this. Okay, blockchain, as most of you know, is phenomenally easy to develop. That's not the problem. So I'm going to read this verbatim. What is undeniable that insurance at Lloyd's, though in existence centuries before, is still behind. At this moment, the business at Lloyd's is subject entirely to the exercise of personal and individual experience, fallible in its very nature. Next one. That was written in 1876. And it's still true. I'm a history buff, as anyone knows me. I see, when I think about ICOs, I think about the free banking era of the 1830s. When I look at the development of blockchain, I go all the way back to written contracts that predated writing, about 12,000 BC, and I see the notes. That's just how I think about the world. So the first thing I do when I got this gig, not being an insurance person, is I read a book about the history of insurance, and I came up with this gem that was written over 100 years, about 150 years ago now, and is still true. The biggest problem here is not any of this, it's adoption. It's how do you get people, and we haven't solved it yet. I mean, I'm very proud. Ask anybody who's worked in the fact that we got a prototype approved and built in a year and a half is phenomenal, and I am hugely proud of my team. There's just some amazingly capable people that got this done. But you know, we're only at the start of the battle now. We've gotten permission to issue the RFP for the production, but we haven't had, you know, people still have to sign on the bottom line to go from prototype to production, and that's the battle we're fighting right now. So I was going to go and just talk a little bit about solutions stuff, but we're pressed for time, so I think we'll go to Q&A.
Big hand, first of all, for Areiel. That's, and the prize for the best corporate slideware goes to, you can tell you what to IBM, sir. Excellent presentation, thank you very much. Okay, hands please, who wants to jump in first? Oh, not you again. Man at the back, come on, let's have you first.
You made everybody's life miserable, so I can't wait. Please, bring it.
You stand up, sir. Stand up first, please.
This is quite interesting actually, because what you just mentioned 5 minutes ago, John, was quite interesting, because I had a program manager who told me I never aligned my technologies with business. You know? Now Lloyd's has moved after the vote Brexit. I don't want to be political, but Lloyd's moved out of the UK. Mm-hmm. You know that?
Yes.
Now, how do you align your technologies, okay, the business models, okay, with the existing
Well, it's a great question. So for those who didn't hear, how do we align technology with business models? I mean, that's, and the first answer is don't start with the technology. Now, to some extent, I'm being a little disingenuous, because when somebody, you know, hired me to do the feasibility study, they didn't pick my name out of a hat. So clearly they were thinking about blockchain when they asked the question of, can we get rid of the Bureau? And there is a reason they asked the question in 2017 rather than at any other point in time in history. So yes, people were thinking about the capabilities of blockchain, but it's not blockchain that delivers this value. It's a decentralized business model. And that's actually something, a kind of thinking that I bring. So one of the things, my tiny, I mean 4 people, so we really are a tiny firm. But one of the things that we do is due diligence for investors on startups. And this is exactly the kind of probing that we do around business models, to say, is this a business model that makes sense? And forget the technology. You can think about the technology once you're sure that you've actually got something that's going to deliver value. So the way to align it is to forget technology until you're absolutely sure the business model is something that makes sense. Then you think about a solution for it.
Now, so my second is this as well. We have a capital, this is a major shipping company. Mm-hmm. Massive shipping company around the world. Everything, anything you do,
yep.
The business. Okay? Now, there are no standards to distribute latest technologies.
Well, actually, that may not be true. My good friend Steve Holmes is actually speaking next, and he's going to be talking about that.
Okay.
So hold the question.
Let's see who else has got a question. Let's have a microphone in the back. Let's go again. Far corner.
Oh, I'm sorry.
Christine, where are you? She's gone. She's there.
Hi, I've got 2 questions for you.
Okay.
The first one is, how scalable is this? And the second one is, if the business model actually works, are you intending to take it out of the UK, i.e. to the developing countries, where they need this kind of technology? Thank you.
Those are fantastic questions. So, how scalable is it? For this use case, plenty scalable enough. Lloyd's functionally is not that different from NASDAQ in the sense that it's a trading floor. In fact, it's one of the world's last physical trading floors. The only difference between Lloyd's and NASDAQ is what gets sold, which is insurance. But in terms of scalability, it's very different. You're talking about a small number of very, very complex products. Okay, the total number of transactions in the market, in Lloyd's market for a year, is 9 million. Okay, scalability won't be an issue in this use case. The more interesting question you asked was taking this abroad, and the answer is not only am I taking it abroad, but I am not waiting for because Lloyd's. I mean, like I said, I'm immensely proud that we got this done in a year and a half. But let's face it, Lloyd's moves at the speed of government. So I'm not waiting. I am actually right now working with the Asia Development Bank and a group of carriers in East Asia to put together a parametric microinsurance delivery platform for Indonesia for making, for the first time, catastrophe cover available to people who couldn't afford insurance. So I'm very passionate about financial inclusion. I actually addressed the G20 in 2015 on the ability of emerging technologies, particularly machine learning, to fundamentally change how the world accesses finance. I spent 2 years in Kenya in 2014, 2015. I led the team that built the credit scoring model for M-Pesa. So I'm not going to wait around. In fact, my contract with Lloyd ends at the end of the year specifically so that I can go do exactly what you're talking
Can we hire?
Yep.
Actually, I worked on M-Pesa as well.
I'm coming available.
Areiel, we'll have a chat about M-Pesa later, I'm sure. So on that point about great comment you made there about financial inclusion, I think this is a really important point that all over the world there are people who this kind of stuff's out of reach. You can't, if you're in some fishing village in a remote part of Indonesia, accessing some form of protection for a tsunami or whatever may come, it's very hard to reach. So that's an enormously important point. And when I think about blockchain and the kind of solutions it can solve, a big part of what I think is really interesting is that idea of that all those people who are currently out of the system can come in the system. Okay, so can we just talk a little bit about how they come in the system? Because ultimately they still need access. Yeah.
I could talk about it. What I may not be able to do is talk a little bit, because this is something.
Give me the elevator pitch. Come on, 2 minutes of max. Let's go.
So historically, the reason that, and this is true of both in insurance and loans, so I'm going to address them together. The reason that financial products like insurance or loans haven't been available to poor people is not because bankers and insurance carriers are evil or racist or elitist or any. I mean, some of them are. Don't get me wrong, but that's not the reason. The reason is much more fundamental. Okay, there were two reasons that these things were not available to places in the world where they're desperately needed. One is that there's always been this perception that poor people are a higher risk. They're less likely to pay back a loan or more likely to defraud an insurance policy. Now, data has proven that's not true, but it's taken a long time to be able to have the level of data science to prove that. In fact, poor people are, it's not statistically significant difference, but are marginally more likely to pay a loan back, provided it's commensurate with their level of income, than a rich person, because more rich people feel like entitled assholes.
Is that the World Bank? Is that the World Bank data then, Areiel, from the microloans program the World Bank had at the UN?
That's part of it.
Exactly that.
Yeah, it's from IFC, which is part of the World Bank. The second reason is that the cost of servicing, historically speaking, a $200 loan is not that much different than the cost of servicing a $2 million loan. It's the same basic process steps. Okay, so to break even and avoid going bankrupt, you would have to charge an exorbitant rate of interest for relative to the low value of a microfinance loan. The ability, what blockchain does, and it's not just blockchain, it's a convergence of technologies, is changes that math. So you now no longer need. So in Mshwari in Kenya, which I did the credit model for, is an entirely you apply for the process on your mobile phone. It goes through the credit scoring, the origination, and a human being doesn't touch it. You can now originate that loan for pennies rather than $10 to $15 it costs to originate a loan. And you can't spend $15 to originate a $200 loan. You will go bankrupt. So all of a sudden, now that it costs only pennies to originate the loan, you can provide that loan at a reasonable level of interest. And that's what's changing. The other piece of it is not blockchain, but is mobile technology. So we talk about Indonesia. Though, if you are lucky enough to actually have an insurance policy against natural disasters in Sulawesi when the tsunami hit, the only way that you can deliver those claims is to send somebody in a helicopter to a village with a briefcase full of cash. And I'm not making that up, this actually happens. That's a very, very expensive distribution model, okay? Now, provided somebody survived the tsunami at all, they'll have their phone in their hands. You can pay the money directly. So it also becomes much cheaper to distribute the claims, which again, makes it possible to charge a reasonable, sensible premium for an insurance policy of very low value.
Fantastic. Ranking them back, bringing those out of the equation back in. Let's try over here. We've got a question for you, sir.
And can we make it the last question because we are really pressed for time? And you can talk to Areiel afterwards. He'll be here, hopefully not running away.
It's fine. Last question before we go on, Mr. Holmes.
Vlad from La Token. Great speech as always, Areiel. So I have a quick question. So once the companies implement the new business model, and hopefully they will have higher margins, do you think they will decrease the premiums for the customers, or will they just stick on higher profits?
Well, I think the expense ratio for London market firms is grossly higher than it is everywhere else, which is why they're losing market share. They have to lower their rates, and it's not because they care about us consumers, it's because they will go out of business if they don't. So the rates will come down, they have to. And the need to do that is what's driving this.
So less and less people actually opting in for the insurance?
Well, that's true as well, but what's more is happening is people are getting their insurance via other channels because the other channels are much less expensive, and when you file a claim, they will pay them much quicker.
Thanks.
Okay, thank you very much. Ladies and gentlemen, big hand for Mr. Areiel.